Every second, stock prices change, but who actually decides the number you see? It's not random. Once you understand this hidden force, the entire stock market suddenly makes sense. When James checked the price of Amazon stock at $178, James assumed that number meant something precise and calculated. It felt like the number reflected Amazon's exact value at that moment. Most beginners think this way because the price looks official and stable on the screen. But the truth is very different. That number was not assigned by Amazon. It was not decided by the exchange. It was not created by a formula that calculates the company's worth every second. Instead, that number was simply the most recent price where a buyer and a seller agreed to trade. To see how this works, imagine James wants to buy Amazon shares at $175. James believes that price is fair and places an order. Meanwhile, Olivia owns Amazon shares but refuses to sell at $175 because Olivia believes the stock is worth at least $180. At this point, both James and Olivia are active in the market, but no transaction happens because neither side is willing to compromise. Then Daniel enters the market. Daniel strongly believes Amazon will rise soon, so Daniel agrees to buy at $180. Olivia accepts that offer, and the transaction happens immediately. The moment this trade is completed, the stock price becomes $180. Nothing about Amazon's business changed in that exact second. No new product was released, no revenue suddenly appeared. The only thing that changed was agreement between two participants. This is how every stock price is created. It is the result of negotiation between buyers and sellers. This negotiation never stops because new participants enter the market constantly with different opinions and expectations. Understanding this idea removes the illusion that stock prices are fixed or assigned. Prices are constantly discovered through real-time interaction. This leads to the next important layer, which explains why prices move up or down instead of staying the same. Inside the stock market, buyers and sellers are always competing. Buyers want to purchase shares at lower prices, while sellers want to sell shares at higher prices. This creates continuous tension. Michael wants to buy Tesla at $240 because Michael believes that price offers good value. At the same time, Olivia wants to sell Tesla at $245 because Olivia believes the stock has already risen enough. Both orders exist in the system, but no trade happens yet because the two sides disagree. Then Ethan enters and decides that owning Tesla immediately is more important than waiting for a better price. Ethan accepts the seller's price of $245. The trade happens and Tesla's stock price moves to $245. This movement happened because Ethan was willing to accept the seller's terms. The key factor here is urgency. When buyers become more eager, they accept higher prices. When sellers become more eager, they accept lower prices. This constant interaction explains why prices never stay still. Each participant has different beliefs about the future. Some participants expect growth, while others expect decline. These conflicting expectations create continuous price movement. But there is another critical factor most beginners overlook. Not every participant has the same level of influence. Some participants have far more capital and power to move prices. When James buys 20 shares of Apple, that trade has almost no impact on the overall price. The market is too large for small individual trades to influence it significantly. But when a large investment fund decides to buy millions of shares, the situation changes completely. Imagine a pension fund decides to invest billions of dollars into Apple. The fund cannot buy all those shares instantly at one price because there are not enough sellers willing to sell at that level. As the fund continues buying, it must accept slightly higher prices to find sellers. This creates upward pressure on the stock. The same process happens when institutions sell large amounts of shares. If a fund decides to exit its position, it introduces a large supply of shares into the market. To complete the sale, it may need to accept lower prices. This creates downward pressure. Most major price trends are driven by institutional activity rather than individual traders. Institutions control massive amounts of capital, and their decisions shape the overall direction of stocks. However, institutions do not act randomly. Their decisions are based on expectations about future performance, and expectations can influence price before anything actually changes in the real world. Sophia noticed something confusing when watching Netflix stock. The company reported strong earnings, but the stock price still fell afterward. This seemed illogical at first. The explanation becomes clear when expectations are understood. Before the earnings report, many investors already expected Netflix to perform well. These investors bought shares early, pushing the price higher before the announcement. When the earnings were released, they confirmed strong performance, but they did not exceed expectations significantly. Because the positive outcome was already anticipated, fewer new buyers entered the market. At the same time, some investors who had bought earlier decided to sell and secure their profits. This created more sellers than buyers, and the price declined. The stock did not fall because the company performed poorly. It fell because expectations were already priced in. This demonstrates an important principle. Stock prices reflect expectations about the future, not just current conditions. This is why prices can move quickly based on forecasts, news, and investor sentiment. Before continuing, subscribe if you want clear explanations that reveal how markets actually work. Most beginners never learn these mechanics, and understanding them changes how you see every price movement. Now, the next layer explains why prices sometimes move faster than expected. Not every participant behaves calmly, sometimes urgency takes over. Daniel believes NVIDIA will rise quickly because of strong demand for artificial intelligence technology. Instead of waiting, Daniel buys immediately at the current price. This increases demand. At the same time, Olivia becomes concerned that NVIDIA may be overvalued. Olivia decides to sell immediately to protect profits. This increases supply. When many participants act urgently at the same time, price moves quickly. Emotion plays a significant role in this process. Confidence can push buyers to act aggressively. Concern can push sellers to exit quickly. This emotional behavior accelerates supply and demand imbalance. This explains why prices can rise rapidly during strong optimism and fall rapidly during uncertainty. However, another factor determines how stable or unstable price movements become. That factor is liquidity. Liquidity refers to how easily shares can be bought or sold without causing large price changes. Highly liquid stocks like Apple and Microsoft have millions of participants trading constantly. This allows large transactions to occur without dramatic price movement. Low liquidity stocks have fewer participants. This makes prices more sensitive. If Lucas wants to sell shares in a low liquidity company, there may not be enough buyers at the current price. Lucas may need to accept a lower price to complete the sale. This creates larger price swings. Liquidity acts like stability for the market. High liquidity creates smoother movement. Low liquidity creates sharper movement. This explains why smaller companies often experience more volatility than larger companies. Understanding liquidity helps explain why price behavior varies across different stocks. At its core, stock price movement comes down to imbalance between buyers and sellers. Every factor in the market influences this imbalance. News can increase demand. Economic uncertainty can increase supply. Expectations can influence both sides, but the direct cause of price movement is always the same. When buyers accept higher prices faster than sellers accept lower prices, price rises. When sellers accept lower prices faster than buyers accept higher prices, price falls. This interaction happens continuously. It reflects real-time decision-making by millions of participants. Understanding this removes the mystery behind price movement. The market is not random. It is a reflection of human decisions. Comment the stock you are currently watching and whether demand or supply seems stronger. Because once you understand how price is truly set, the market stops feeling unpredictable and starts making logical sense.